No, it's priced in. Nah, it's priced in.
Preston.
No, it's priced in. All right, ladies and gentlemen,
Top
if you
player.
haven't figured it out by now, today's watch list is going to be a little bit different, and I thought we should talk about the mysterious nature of things being priced in. It seems like over the last few years, no matter what happens in the market, everybody's answer is, it's already priced in. It's already priced in. So this came as a question today from Eric on stream. It was a really good question, and I think it relates to everything we have going on with how the market's moving, how the Fed futures and the bonds, even the earnings plays. We hit another 1,000%er on TSM, $60 into just under $600, and all of this is an answer of things being priced in. So it's a pretty
Scary
complex
dip
topic.
right
I
here.
thought I would touch on a lot of different things and give you some pretty easy to understand examples so that this could help you moving forward and give you some ideas and things to look at. Now, before I do any of that, we still have a market open tomorrow. We have to deal with a little bit of data. There is going to be the consumer sentiment, and that will be our only set of data there in the morning, and that has the ability to move things. But if you didn't see what happened today, the market found a way to go back up. We're still holding that 1 month range of being in the same range, but what happened that was a little bit spooky, the bond market kept going lower, yields kept going higher, the dollar kept climbing. And why? There was a couple of reasons. One, it was TSM earnings. It spurred all of the chip makers. People got excited about that in AI. That's why we hit 1,000%er on that. After hours, SMCI, they raised their guidance. That's another thing relating to being priced in. And then on top of it, that little 3-month delay in the whole government spending, they got one until March. So there's a lot that we have to digest here, but I think tomorrow should be very straightforward. It's a big option expiration, and I think afterwards we will start moving bigger. But here's the last thing I got to give you. Today and yesterday, there was a Hindenburg omen that has been triggered. If you want to search the trading fraternity Hindenburg omen, I made videos on this in the past, the last time it's happened, and what it is saying is that 2.2% of stocks are hitting 52-week highs, while 2.2% of stocks are hitting 52-week lows, while the market is trading above its 50-day moving average, and that is usually a sign of impending volatility. A lot of people want to say it means there's going to be a crash, but what we've come to realize, it either means you are going to rocket up or you are probably going to die. It could also point to volatility to the upside. So I'm going to leave you all with that. I hope I see you on stream tomorrow, and what I need from you now, a thumbs up on the video. Make sure you're subscribed. And speaking of stream, if you don't know, baby, we are live every single day, Monday through Friday, 30 minutes before open, youtube.com/thestockmarket. We will see you there in the morning. But now, let us get into this tricky topic, man, of things being priced in. I know you have heard this, and I hope by the end of this you are able to learn a little bit. So let's start with the first key. Just because something is expected, it doesn't mean that it's priced in. Like I told you, we were on stream today, and we had Raphael Bostic, and he came on, and he said exactly what he has said in the past, and if you heard the other Fed speakers before, some of that may have not been priced in, let alone expected. There was a big market reaction, but ironically enough today, he said the same exact thing. There was a reaction, and then by the end of the day, you did bounce up, but Eric was asking, why in the world did this happen if everybody knew what he was going to say? And this is your first lesson right now. Just because something is expected, it does not mean that it is priced in and showing up on an asset, equity, option, whatever you're looking at. But now on the other hand, if you do notice that the price of something is higher or lower based on what is expected, then that is how you know it is priced in. The answer for today, how come Raphael Bostic wasn't priced in? Because this is the dilemma we have been dealing with. Although people may expect the Fed members to sound bearish, sound hawkish as of late, if you go look at the Fed futures, the price of the bonds here and what people expect the rates to be at, those prices are still indicating something dovish. Not pay money back. That's why we're going to charge you interest. We're in place to build your foundation at. those prices are still indicating something dovish, and that is where we are running into problems. That's why you could get some moves, and that's why it is very complex to price things in or not. Now, maybe this is all too confusing. I want to simplify this for you, and that's why I have two examples. Let's start with the first one. You are a 16-year-old driver. You just got your license. Even though you have never crashed a vehicle, your insurance premium will cost more. Why? Because they are pricing in the risk that you have as a driver. You haven't crashed the car ever or yet, but they are expecting a higher likelihood of an accident, and that's why they are charging you more money. Again, if the price is higher or lower based on that expectation, then it is priced in. That's a very simple example. Yes, the markets are complex, and you'll see as we get into it, but this is a very good place to build your foundation in terms of things being priced in or not. If it's not priced in and showing up on the price, even if it's expected or not, that is what you are looking for. The second example, you are a 50-year-old person. You have never missed a payment on any of your credit cards. You've had a steady job for 20 or 30 years. If you go bankrupt, that is most likely not going to be priced in, and I'm sure all of the banks leading up to it probably gave you a loan at a lower interest rate. They looked at your history and said, based on this, well, yeah, every person may not pay money back. That's why we're going to charge you interest. We're giving you our money, but they're going to charge you a lower amount. But if you go bankrupt, they were charging you so low because of your past history, they didn't expect you to do anything, and they priced that in. But the event of you going bankrupt, there's really no way you could have priced that in. That's why all the time when you hear of like a big company, you even think like FTX and that going bust, everybody thought they were really solid no matter what you thought about it. There's no way you could have priced that in because the history on it, you were like, okay, that's good. People, you may have expected it, but if you looked around, that wasn't the price of the FTP token or whatever it was until people found out what was going on, and that's why it was such a gigantic decline. So hopefully these examples can help you out now, but in terms of the stock market, where should you be looking to understand where things are priced in? There's a couple of things that we could look at. It is options, earnings, the index, and the bonds. So we already talked about the bonds. We'll get back to that one at the end. That's where all of this started from, but let's take a little bit and look at the options. I've showed you this with that tutorial at the beginning of the month. You know, we're hitting these 1,000% plays. We're going over the option chain, and we're saying, hey, if an event is supposed to happen on a company, most likely the price of that option will be higher or lower to indicate what is expected. A lot of times, the options, the market makers, they're right on the money. If they're saying, well, nothing outside of expectations are going to occur, they are pricing it to move generally like it has in the past, and they're factoring in a couple of new things. And this is what you got to look at. When I'm looking for a cheaper or more expensive option, I look at the price, because if that price is higher, and especially if the play is further out of the money and unexpected, there is a higher likelihood of a surprise being priced in. By charging a higher price, even though the expectations may be there or not, even if the reality of the event is surprising or not, by charging a higher price on the options, the market makers, the other parties who are willing to sell or buy those options, by having a higher price, they are accounting for those surprises happening. That means it is priced in. If you pay a higher price for an option and it moves 10-20%, but you paid 50% more for that option, it may not move a lot because that high price has priced it in. On the contrary, now, if there is a lower price on an option, you start looking at the chain even a little bit further out the money. It's not costing a lot. You've seen this. You see this a lot on the short terms. That's why people like the dailies, because people try to figure out there's a lot of certainty on a short amount of time. The prices go lower. They're like, yeah, nothing's going to happen. But if you see a lower price on a stock, it either means there's a lower likelihood of a surprise being priced in, or nothing is going to happen. But again, even if there is an expectation, if the price is lower and people aren't paying to reflect that price, there's a good chance what is happening or what could happen a surprise for that nature is not being priced in. So this is the simple one. We've talked about this a lot. Again, this is the whole notion of going to the option chain. You go and see, and you'll notice even on earnings, I've showed you this one with like companies like Netflix and whatnot. You go to the option chain, you could type it in. You'll notice here there's a plus or minus. This is saying how many dollars are priced in. This is literally where implied volatility is getting some of its info from. But what we said, you go to a company on earnings, and most of the time, the contract week of earnings, the options will have a higher price because there is an event that's going on. Sometimes, if people don't expect a lot for an event or had already had news prior to it, the pricing could change depending on that. This is the simplest thing and a very valuable thing. If you didn't go check out the tutorial, how we turn $600 into $7,000, I posted that at the beginning of the year. That will definitely help you out with this concept and teach you a little bit about the options. But hopefully you're understanding on that one. But now let's talk a little bit about the earnings. This one is very important because I'm sure you have seen earnings come out on a company, and depending on the result, how many times have you seen it? A company may have quote-unquote beat or had a good earnings and the stock goes down, and vice versa. We've seen companies lose billions of dollars and the stock will rocket up. Why? It depends on what was priced in. If you're not aware, companies give guidance every quarter. Not all of them, but most of them. They give a quarterly update and they say, this is what we are expecting to do next quarter. Once people get that, they start buying and selling the company off of this. The price will change depending on what they said about the future. And then the analysts go on, and these are the guys who study the companies. You should see my other video on analysts. A lot of the time they're wrong, but unfortunately, they do affect companies and how they react. And this is where it comes down to things being priced in or not, because if analysts are expecting a company to do better than their results, than the guidance that they gave in the prior quarter, if they are expecting them to do better, the company says we're going to make $1 billion, and the analysts are saying, no, we noticed the trends and this and that, we think they're going to make $1.2 billion, then if they have a better earnings, chances are the results are priced in, and that's why sometimes ahead of the earnings, the stock will go up. These analysts upgrade it. They are saying, no, we expect them to do better. People react. They buy the stock. The stock is getting priced in for a better expectation. They expect it to happen, and then the price is going up. They are buying into that expectation. That's where something is priced in. On the contrary, this is where it gets a little confusing, because sometimes the analysts will say, no, the company is going to do a lot worse, and they're saying, we don't think the company will do good. They'll start selling it off, and people will react to that expectation and sell the stock off ahead of earnings, maybe 3 months ahead of their earnings, and then the company comes out. A good example is Micron, and they're saying we have negative margins, we did very bad, and we have a lot of problems here, and then the stock will go up, and people are like, why did that happen? It's supposed to die, because this idea and expectation of them doing bad by people already selling it, they have already priced that in. A bad result will not be as shocking. So where do the surprises happen? It's when the analysts are matched up with the companies. The company's like, we're going to make $1 billion, and analysts are like, okay, that sounds about right. And then they do really good, and they make $2 billion. The stock surges. A good example is Netflix as of recently. If you go see that run-up, everybody was like, no, they're not going to sign up anybody. They're only going to get 1 million members, and boom, they got 7 million members. Not one person was expecting it. The stock goes up 20%, and vice versa. When you saw a lot of these companies start to fall off of a cliff after 2021, 2022, it's because everyone was like, no, they're going to do good. They can withstand all of this, and then they would be like, yeah, nobody's buying chips anymore. I guess crypto hurt us in this area, whatever. You can fill in the blanks, but nobody was expecting it. Bad result comes out, and then the stock does drop because people were not forecasting that, whether they expected it or not. Even if some people did, if the price did not go according to that, and again, you could use the options ahead of those events to see that, those events were not priced in. So this is why, if you ever been on stream, I'll give you a basic example without needing any crazy tools. You could go to like Yahoo Finance, even NASDAQ.com, and just go to the analysis side, and it'll tell you how many analysts are on a stock and what they're looking for. Like today was TSM. The guidance people were expecting on average was 18.2, and they came out and said we're going to make anywhere from 18.0 to 18.8. higher than the highest estimate, and that's why people are like, oh yeah, that guidance is good. And they also had a lot of other metrics that went up, but you have to go see what the company has already priced in. That's why if you come on stream ahead of earnings, there's a reason why I do those earnings previews. I go over every company that is going to be reporting, and I share with you, here are the numbers that the company's expecting, and then if there is that information available, we go and see what the analysts are expecting to get a general idea of what is priced in or not, and then we go to the option chain and do our analysis. So hopefully this is helping you out. Another big one right here that you got to be looking for is the indexes, and they price things in. Now, this is related to the options as well, but when there's a lot of macro events or global tensions going on, you have to go look at the index insurance, what people are playing both ways or how they are trying to balance it out. This is what we call a lot of the time event risk. And how can you know? How do you know if a non-farm payrolls, a CPI, or again, something happens in the world? There's a crazy. So right now, a little bit higher in terms of the dollar amount, but it is about $2.86 being priced in. The market's already closed. It's going to open up tomorrow. This is a great place to start looking at what is going to be priced in for tomorrow. And what do? Take 286 and divide it by the price of the S&P, 476.49, and we are left with 0.006. So what does this mean? For tomorrow, there is a chance, and the market is already expecting and putting a dollar amount that the market will move just over 0.5%. So guess what? If it moves more than 0.5%, that means it wasn't priced in. If we go up 1%, if the consumer sentiment has a blowout number, that would be unexpected. It wouldn't be priced in. So if you get that result tomorrow, the consumer sentiment absolutely plummets, and then the market rockets up 2%, if you were like, it's priced in, you can't really say that, because coming into today, it's saying it's expecting about 0.06, but vice versa. If that data comes out, the market shoots up, shoots down, dances around, and before you know it, we even close at 0.5, 0.4, even at 0.06 or 0.6, 0.5%, then that means it was all priced in. Although events did happen, yeah, we could have got this and that. Based on the price and what people were willing to pay, you'll see that expectation there and how people decided to move around. It's not like it was anything out of the ordinary. So hopefully you understand, and hopefully you're seeing how all of this links in. And now the final part, this is what we started with today. The Fed futures and the bonds. Oh, it's kind of a little weird. You got to see up here. But the bonds, the Fed futures, this is one of the number one ways to see what the bonds are really pricing in. Even the yield on a bond tells you something. You got to think about it. That's why an inverted yield curve in a yield curve, a normal one, is so important, because shorter term yields should be lower because expectations should be more certain. Let me give you an example. Like I just showed you with these option chains, depending on which date you're looking for in the risk. But what do you notice about these numbers? We start at the weekly, the daily, 0.4, 2.8, 4.0, 4.7, 5.4, 6.1, 7.4. Let's go down. Let's get to the end of the year, $71. That is a lot different. Let's go to the next year, $135. What should happen? Shorter time frames should be lower than longer time frames. For the last 2 years, almost the longest since 1929 at this point, the bonds have been doing the exact opposite. That's why you have an inverted yield curve, but the yield on a bond and the duration, it is telling you something about what people are expecting and pricing in for the future. That is why when Powell and the whole gang said they're going to do stuff, all of the bonds, what people expected in the next 3 months, 2 year, 10 year, etc., it started to move. The Fed futures today, this is the dilemma right now, because whatever you think is expected, whatever you think the Fed people are going to be, so they're going to sound sketchy, the market should price that in and be ready. Unfortunately, they're not. You go to the Fed futures, this is that thing we've showed you all the time, and you could just go to investing.com, just Google Fed rate monitor tool, and you'll find the investing.com link. You go to these Fed futures, go to December, the market is still pricing in 6 rate cuts by the end of the year. Powell and the Fed, their dot plot last showed 4. The market's saying, nah, we're going to get 6. Not too long ago, it was just saying 7 rate hikes. So even though people might expect that Powell and the gang is going to fight back or the data is going to do something, although that expectation exists, it's not being priced in. Right now, even though the Fed's saying 4 rate cuts and people could expect a rate cut, the market is pricing in more of that, and that's kind of the dilemma, is because you have everybody arguing, well, wait, we knew that would happen. We didn't know that's going to happen. That's why when data is coming out unexpectedly and has the ability to move things, that's what's causing these knee-jerk reactions, because we are pricing in one thing and either the data or an event is causing something else. So simply, if a Fed speaker is saying a bunch of stuff and it may not sound good, and even though you expected it to happen, if the bonds and the Fed futures are not trading and moving, or maybe they have a knee-jerk reaction and come back up, if that pricing and what people are willing to pay for that in the future does not change, technically it's not priced in. So that's where it's like, okay, maybe it should have been priced in. Yeah, he was very bearish, but the market is only pricing in bullish right now. So to wrap it up and to keep it simple, expectations can affect pricing, but not everything that is expected is priced in, and this is the paradox. And hopefully you see it, because unfortunately all of these things work together. The options, the events, every company has so many events going on, the earnings and different analysts, and there's a wide range of the analysis, the index. Sometimes things aren't priced in, and then something happens, and then it quickly gets priced in, and then you're now operating off of that. And if it's priced in and it charges a higher price, you may go for the play, and then the situation calms down. You paid the higher premium of after it was expected in a higher probability, and then things start to move around once again. And then the bonds are in their own land, and they're affected by a lot of things. It is very complex. So hopefully you get a good idea and you could watch all of these, and this is where you're going to have to know what to work in or not. But as we're watching the market and different dynamics are playing out, you got to keep this in mind. Things can happen that are expected, and people's expectations can change, but what the price is saying, that is what is really communicating what is actually priced in or not. And I hope you enjoyed this one. So, Chad, that's all I have for you. I will see you tomorrow, and let me know if you have any questions. And I don't know, I've been in a tutorial mood this year, so if you want me to make a video, maybe a part 2 to this or anything, let me know in the comments.
From New York City, for our viewers worldwide, a very good morning. I'm Manis Cranny in for Jonathan Ferro. So what you have is tech on a ripper as the rates market tempers its ratchet higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up this morning, the U.S. jobless claims plunged to the lowest level since 2022. Fed officials pushed back against the rate cut expectations, and tech rallies as Apple gets an upgrade and TSMC delivers a bullish outlook. We begin with the big issue. Is good news bad news?
We're back into this kind of good news for the economy is bad news for the market.
Bad news is good news.
There's just a lot of good news.
The economy is actually doing great.
Look at the data.
You see the retail sales numbers.
Strong retail sales.
Industrial production, LEIs are bottoming.
The consumer's been really resilient. Just saying economic resilience.
And it seems like the whole soft landing is happening.
Fed is not going to rush to start implementing those rate cuts.
The market's a little optimistic on the rate cutting cycle.
A little too optimistic in the start of the timing of rate cuts.
The 6 rate cuts, that's a pipe dream if we have a soft landing.
The economy has been strong enough so we can keep rates stable for a while.
At some point that you will start to shift to, good news being good news and bad news just being bad news.
Good news is bad news. Joining me now to discuss that thesis, it is Morgan Stanley's Jim Caron and Seema Shah of Principal Asset Management. Seema, let me bring it straight to you. My favorite, by the way, is Ken Rogoff. In other words, we're living in a pipe dream on 6 cuts. But you say, Seema, the long-awaited downturn should arrive and depart without leaving much destruction. Inflation should continue to decelerate, and most importantly, the Fed is likely to open the door to cuts. Well, they're trying to slam that closed at the moment, Seema. My question to you is this. Are you recalibrating your rate cut trajectory in a post-Waller world? Good morning.
Good morning, Manus. Okay, so no, we're not recalibrating. I actually think that what we're expecting is very much in line with what you've just heard from a number of analysts on the street. What we're saying is, in terms of how the market is pricing rate cuts for this year, it is too soon. Too soon. March is very, very premature to think about rate cuts. At the same time, and probably more important in terms of the timing of that first cut, is how many cuts. Now, we would say that 6 to 7 rate cuts only happens if you've got a deeply negative economic backdrop, which we're not anticipating. But because inflation is coming down, it's going to come down fairly wobbly. It's not going to come down in a straight line, but it's going to get closer to that 2% level. And around mid-year of 2024, we are expecting the Fed to be ready at that point to start cutting interest rates, but to go very gradually. So we're only expecting 3 cuts for this year. So not a change in the forecast. I think at the end of last year, the market was just far too optimistic. And at this point, you can only get slightly bad news for the market.
That's why we love bond traders. It's called natural irrational exuberance. Jim, let me bring it to you. Any recalibration for you, or are you as stoic as SEMA is?
So, look, I mean, I think that the Fed is likely to cut at least 100 basis points this year. And that's just really to keep things neutral, right? I mean, if inflation's coming down, which it is, the Fed needs to change its nominal policy rate to match what inflation's actually doing. So, clearly the debate is over whether it's 6 cuts, 5 cuts, 4 cuts. Is it more than 6 cuts? In terms of the markets, it's really a question of correlation. And what the correlation of returns are is that stock and bond returns have been highly correlated. The problem with that is that there's no place to hide. You can't get diversification because effectively, if stocks go down when bonds go down in returns, it's hard to have one hedge against the other. So essentially what happened is, it seems, and I think SEMA was alluding to this, is that there was a large pull forward in expectations of rate cuts, and we started pricing in by the end of the year 6 cuts. If it's going to be less than that, then naturally bond yields have to rise. And because there's high correlation between stocks and bonds right now, that's going to put pressure on the equity markets. So like the premise of is good news bad news, is bad news good news, I think it's really a question of what the correlations are between returns of stocks and bonds in the markets. So, look, clearly retail sales came out pretty strong. We're seeing a strong jobless claims number that came out today. Yep. Yeah, we probably have to recalibrate a little bit.
Okay, so a moment of recalibration or reflection. Let's not force you straight into recalibrating. Let's talk about those jobless claims, as you say, this morning, and more Fed speak in the pipeline. Mike McKee is with me. Very solid jobless numbers, Mike.
Yeah, everybody always goes to the equity markets when they do their market boards. And today you want to start with the bond market because there's certainly been a reaction to the 187,000 jobless claims filed last week. That's the lowest since September of 2022, and it harkens back to pre-pandemic days. The question is it real or not? We saw a very similar move last year in the same week, and then we started going back up over 200,000 again. We'll see if that follows. But that drop also drops the number of continuing claims as well to 1,806,000, suggesting people are still getting jobs. The Philadelphia Fed number comes in still down, negative 10.6, but the number that catches your attention is prices paid, 11.3 from 24.3. That suggests still more progress on inflation. So where are we? Well, yesterday the Fed came out with the Beige Book, and the Beige Book said basically there's little or no change in economic activity and little or no change in overall employment. In other words, things are still pretty good. Chris Waller, as Manus mentioned, talked about cuts coming, but methodically and carefully this week. Raphael Bostic on the tape just before jobless claims coming out, saying he wouldn't want to cut and then have to raise. He wanted more evidence that inflation is going down. He got some mixed numbers today. We do have more Bostic this afternoon, and then Mary Daly gets the last word from the Fed tomorrow before the blackout. And I threw this in because we haven't had a lot of change in the March estimate for quite a while, that they're not going to do much. But today we have seen a drop down to 52% chance of a Fed move in March, and that is just rapidly going away. And they still see a lot of moves in February, however, by December, however. So we'll keep an eye on that, and that'll depend on the evolution of the data. And it looks like at this point that it's going to evolve in the direction of less inflation, still more growth.
Okay, Mike, thank you very much. Mike McKee setting the table there from the Beige Book to the jobless claims. Jim Caron, Seema Shah is with me. Let's just step back for a moment, because if the recession or mild slowdown is delayed, it's not that aggressive. The rate cut trajectory, a little bit delayed, not that aggressive. The world does not fall apart. We don't know what happens in the Middle East. How does risk, how do you think asset managers, fund managers, how do you think people look at risk in this first 6 months of the year? Seema.
So I do think that the first 6 months of the year are going to be marked by a fair amount of volatility. You know, as a year as a whole, we think it's a decent year. We think risk does okay, and certainly not as well as you saw in 2023 for equities, but it's still a positive year. But in the first part of the year, because there's going to be so many question marks about when does that rate cut come, that debate continues, and it's going to rile the market. And I think Jim and I have a very similar theme going on. We're talking about it in slightly different ways. But at the end of last year, all the good news was priced in.
Yeah.
A soft landing and early rate cuts. And from there can only be disappointment. And I think so that's why you get volatility. And I think for asset managers, it's important to look through that volatility and focus almost on that medium term into what happens once you do get those rate cuts, and how do equities and credit and certainly alternative assets perform. And I think for us, it's certainly a time for diversification, but still leaning into risk.
So, Jim, let me take that across to you, because for me, as you stand on the outside as a humble retail person exposed to this, you go, actually, thank you. I'm glad to see a bit of air come out of the tires here. I'm glad to see a 9-week rally in equities stall a little bit and yields back up. Do you appreciate the opportunity that this all might present to you from a risk perspective?
Yeah, I do. And look, I mean, you know, one of the things I always like to say is that one of the risks in the market is the upside risk. And just like any other risk, you need to hedge that risk. So if we take a step back and unpack what Mike McKee just said, we are having a decline in inflation, which is good, but the jobs market is not actually experiencing high levels of unemployment. Now, when you look at the Phillips curve and you look at most standard measures of the economy, typically what you would see is that it's required that the jobs market weakens quite a bit in order to get inflation to come down, and we're not seeing that. So what that tells us is that the consumer, as long as they keep their jobs and wages are still good, can continue to consume. And this is what's baffling the markets at this point. Everybody's trying to figure out where's the money coming from. We had strong retail sales. We had strong numbers in the third quarter, strong numbers in the fourth quarter, and everybody's waiting for this to actually pull back. So yes, I mean, I would love to buy a dip in equity prices at this point, but what we have to recognize is that dip may be more shallow and may come faster, and that if the earnings, as consumers continue to consume, really get back on track, that could actually put upside risk into the markets. People are worried about downside risk. I get it. I am too. But we also have to recognize that the tail to the upside could be fatter than most people think.
I want to talk to you about credit, and I'll tell you why. I'm probably the best contrarian indicator in the world. So I'm a little bit obsessed by Rick Ryder came on the show last week, and he practically sold me everything that BlackRock could give you on investment-grade credit. And here's the story of the day. Teflon in the credit markets. We, the retail investor, have rocked up and put nearly $8 billion into credit last week. So, Seema, with that in mind, if this herd mentality is careering towards credit, are you part of the herd, or are you contrarian like me?
So look, we do like investment grade credit. We like it certainly a lot more than high yield. And there's a number of reasons for that. You know, if you're expecting a bit of a slowdown, even if it's not a recession, then typically that higher quality space is going to outperform. We look at the maturity schedule for this year. It's not particularly pressing, but it's certainly more pressing for the high yield space than the IG space. But overall, look, you are getting decent yield at this point in time. As I said, I do think you need to diversify, and overall, I think credit is going to do a little bit better than you're going to see for the treasury space this year, but it's not the time to be just solely focused on credit. We need to be looking around the rest of the market and see where the opportunities are.
Okay, well, maybe I should diversify the perspective. Jim, let me finish it off with you. Would you gorge on a little bit of credit, sir? Anything for you this morning?
Yeah, so effectively, it's really the way that we create it in our portfolio. So I do like investment grade overall as a rating for our fixed income part of our portfolios. But I do like to dabble in a little bit of high yield, a little bit of bank loans. I like to think about some of the lower quality components of the credit markets, like even in the triple C, single B sector, because the dispersion in value between the lower credit quality sectors versus high quality is actually quite wide, making the lower quality parts much, much more attractive. The higher quality part of credit is actually going to be more duration interest rate sensitive. So if rates go up for a good reason, the duration sensitivity is going to hurt you in fixed income, but the credit quality, the default risk, actually all of that can improve and you can get better valuation. So I have a very diversified mix. I'm barbelling it between some low quality and high quality. Overall, I'm coming out with exactly what Seema is saying, an investment grade overall portfolio, but I'm constructing it through a barbell.
There's no shame in dabbling in the higher risk trade. And of course, it's Rick Reader, not Ryder. Apologies to Rick. Okay, team, you stay with me. Seema, Jim, we've got a little bit more work to do. Joining me now on set to talk about the stocks ahead of this opening bell, it's Abigail Doolittle. What have we got? Upgrades in tech abound.
We do certainly have an upgrade in tech, and a big one, because we, of course, into today had 2 down days for the S&P 500. But now with Apple's upgrade at B of A to a buy, that stock up 2.2%, one of the biggest weightings to the major indexes. We're looking at a bit of a rebound, despite a number of legal defeats recently that Apple has suffered from. This upgrade on the potential for Vision Pro, their virtual reality set, well, investors really liking it. Humana, on the other hand, not so much. Plunging down nearly 13%. They basically pre-announced to the downside. They've cut their 2023 outlook on higher costs of care. The earnings now looking at $26 per share versus greater than $28. To end on another bright spot, though, in Humana's NVIDIA up 2.3%, as though that 240% plus rally last year weren't enough. Well, we have the stock climbing potentially to a new record high today. A bullish update from Taiwan Semiconductor on the AI space really seems to have those NVIDIA investors gunning to the upside once again.
They have indeed. 2 words: solid growth, solid quarter. Abigail, thank you very much. That's the trajectory from TSMC. Coming up, Middle East tensions, they ramp up. Twin strikes in Yemen and Iran.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action. We have now taken action. We've demonstrated we're prepared to back our words and warnings with actions, and I believe that will make a difference.
The geopolitical factor kicking in to oil. That conversation next on Bloomberg.
They're doing it because they're backed by Iran and they've had weapons provided to them to Iran. And, you know, between the 19th of November and last weekend, they'd made 26 attacks. We'd given warning after warning, but we hadn't taken action. We have now taken action. We've demonstrated we're prepared to back our words and warnings with actions, and I believe that will make a difference. This is about freedom of navigation. We want to have the freedom of navigation. It's vital not just for our economy, but for every economy in the world.
The U.S. launching fresh strikes in Yemen, targeting 14 Houthi missiles that were reportedly ready to launch. Meanwhile, Pakistan's army striking back at Iran. This is in response to the previous day's attack. Both sides signaling unease around possible escalation.
Pakistan has said that we would like to have peaceful relations with all countries in the region, including with our neighbor Iran. Pakistan considers the people of Iran as our friends and brothers, and we have no interest in escalating any situation.
And the geopolitical fear factor is seeping into the oil prices this morning, reacting on the rising risk, escalation risk, I should say. Up over 1% on WTI this morning, 73.35. Team coverage starts tonight. Kaylee Lyons in Washington, D.C., Will Kennedy in London. Katie, good day to you. On top of tracking down the hustings around the country, you're also dealing with the news flow here in the Middle East. This is very much a demonstration of capacity by the Americans against the Houthis, isn't it?
Absolutely, Manus, but also the Houthis still do have remaining capacity, clearly, because just yesterday, right before the U.S. conducted these strikes on the 14 Houthi missiles that they said posed an imminent threat to vessels in the region, Another U.S. ship was attacked, the Genco Picardy. That's at least the third ship that has been attacked since the U.S.-led strikes began back on January 12th. We have now, with yesterday's action, seen at least 4 U.S.-led strikes trying to take out Houthi capability. But because they are still clearly attempting to launch missiles, that capability has not yet been wiped out, which raises